Although private equities have been holding considerable assets in the global packaged food market, but the most recent acquisition of Heinz by Berkshire Hathaway and 3G Capital for $28 billion is by far the biggest scale in the industry. In the past, private equity funds have been investing in iconic food brands and portfolios with various aims and differing results. For example, Yoplait, currently the world's third largest yogurt label, was invested by a French private equity fund, PAI Partners, back in 2002 with the aim to aid international growth. However, not having had a much impact on the brand's international expansion in 9 years, in 2011, the fund sold its 50% stake to industry player General Mills. Based on 2012 preliminary results, so far, Yoplait's international growth has not picked up strongly and continues to face a strong competition from Activia and Yakult. Or PAI Partners, again, is one of the private equity owners of the UK's leading biscuit manufacturer, United Biscuits, which has been up for sale since 2010. However, despite the long line of high-profile suitors, which included the likes of Kellogg's, Campbell's Soup, or China's Bright Foods and Wahaha Group, no offer was accepted. So in the summer of 2012, the owners of the business divided it into 2 units, salty snacks and sweet biscuits. By the end of 2012, the salty snacks unit was sold to an industry player, Intersnacks. But it's very likely that the remaining sweet biscuits division will find an owner very soon. Also in 2012, Lion Capital, the private equity owner of the UK cereal manufacturer Weetabix Limited, sold a 60% stake in the business to Bright Foods, China, one of the top 10 Chinese food and drink manufacturers. Now Heinz, the world's 13th largest food manufacturer, is under the ownership of Warren Buffett, founder and chief executive of Berkshire Hathaway, and he has the reputation and history of investing into iconic global brands with a long-term vision. He owns stakes in companies from Coca-Cola to IBM to General Motors. Under this new ownership, Heinz will not benefit from the operational synergies in the same way than as if it was acquired by an industry player, but it could get a significant financial boost to make a large-scale acquisition into entering new markets and categories and realize some of its long-standing ambitions, for example, to become a major player in global baby food. Given the reputation of its new owners and the company's consistently positive financial performance, it is unlikely that Heinz will face the same fate than, for example, United Biscuits of being sliced up and sold separately.